This is Cashflow Ninja, episode 178 with Hunter Thompson.
Welcome to the Cashflow Ninja, the podcast empowering and inspiring people to discover how to generate their own income and manage, grow, and protect their own wealth in the new economy. Now, here is your host, MC Laubscher.
Hi there, MC Laubscher here, and welcome to another episode of the Cashflow Ninja. I have a great show for you today, and in today's show, we're going to look at how to add value to self-storage investments. My guest in this episode is Hunter Thompson. Hunter is a full-time real estate investor and founder of Cashflow Connections. Since starting Cashflow Connections, Hunter has helped investors allocate capital to over 100 properties, which have a combined asset value of more than $350 million. His experience includes investments in self-storage facilities, residential mortgage notes, mobile home parks, single-family acquisitions, hard money loans, office buildings, and multifamily real estate syndications. In connection with these investments, he has worked with some of the most experienced and well-respected asset teams across the United States and Canada. Hunter is also the author of Little Boxes, Big Profits, a passive investor's guide to self-storage. Please share your feedback and thoughts on today's interview. You can let me know your thoughts on Twitter by tweeting me at MC Laubscher or by email at info@cashflowninja.com. And please remember to join our mailing list by signing up at cashflowninja.com or texting Cashflow Ninja to 44222. To ensure you never miss one of our episodes, you can download our free interactive smartphone apps from the Apple and Google Play app stores. You can also support the show by becoming a patron on Patreon for $10 a month. And when you do become a patron, you get access to our private Facebook page and a Cashflow Ninja t-shirt. You can become a patron at cashflowninja.com/support. Have you read Rich Dad Poor Dad? Are you interested in real estate investing and don't know where to start or how to get the results you want? For valuable information to get you started, visit JoinOps Properties at joinopsproperties.com. If you're not earning at least 8% on your cash or money in your self-directed IRAs, you do not want to miss the private lending presentation for non-accredited investors done by Jimmy Freeland and Bob Scott. Discover how to create an income stream from real estate without the management headaches. You can access the presentation at cashflowninja.com/private lending. Spartan Invest have a proven plan and system, helping investors create passive income and wealth through turnkey real estate ownership in the exciting market of Birmingham, Alabama. Find out why Birmingham has got it going on, why it's a steal right now, why it's a millennial hangout, a hidden gem, and one of the most exciting investment opportunities you have never heard of. You can download your free report, 5 Big Reasons to Invest in the Magical City of Birmingham, Alabama, at cashflowninja.com/Spartan. I've spoken about the most powerful system on the planet on the show, the banking system, and my firm Valhalla Wealth Financial helps people reclaim the banking function within their own lives through leveraging the premium tools and strategies of the wealthy. If you're interested in reclaiming the banking function within your own life and the infinite banking concept, you can access a free webinar presentation at cashflowninja.com/be-the-bank. Hunter, welcome to the show.
MC, thank you so much for having me. It's an honor, man.
Can you please share a little bit about your background and journey with my listeners?
Absolutely. So, I was interested in economics in college, and I think that that's how a lot of these stories start, but I didn't really learn a hell of a lot. I was interested in the topic, and that was kind of the way I was heading educationally. And then 2008 happened, which was a major paradigm shift for a lot of people. Now, you hear that a lot, but for me, that was when I was interested in investing for the first time. I kind of realized that asset prices had collapsed. There was probably going to be some opportunities basically in a vast array of different asset classes, from stocks to bonds to mutual funds or real estate or even businesses. And it didn't really click to me until 2010 happened. And this is something I've talked about in the past, but it was just, that's really my paradigm shift. And the reason I say that is that that's when the European debt crisis really started to take hold and really affect the markets in the US. And I remember watching CNBC, and they were talking about the Greece bond yields. And they were saying if the Greece bond yields remained below 7%, that the S&P 500 was going to be fine. But if they went above 7%, the S&P 500 was going to collapse. And I just remember waking up early. I live in California, so waking up at market time to watch and see what these Greece bond yields were doing. And I just realized that, how can my financial well-being, how can my financial portfolio, how can my outlook on life as it pertains to finances be in any way determined by the Greece bond yields, let alone it playing a determining factor in something so ridiculous and unmitigatable and unpredictable as that. And this is really, when I started looking at investing, particularly real estate, because of the ability to diversify outside of the correlation between the stock market and the overall economy and your particular investments. So that's really how I got started. A little bit of background about my background there.
You're in a very, very interesting niche, and we're going to jump into self-storage today. Have you always invested in self-storage, and where did you start? What was kind of like your progression as an investor after you started investing in your education?
Yeah. So, I started, the first investments I ever made were in performing debt. Real estate debt, not typically referred to as hard money loans because the properties were seller financed. So I was buying seller finance notes, and I was able to do these at 7-year notes at 10 to 13%, which rates are pretty much, these aren't available anymore. This is 2010 and 11. And, I was thinking at the time, and I still think to this day, debt is a great tool for investing because you can have the benefits of cash flow, but it doesn't come along with the headaches that's associated with owning actual property. So we were getting passive cash flow basically directly to our bank account from the home owner, and they were owning the homes and had access to leverage. But we didn't have to deal with the tenants. We didn't have to deal with the toilets. It's the same position as being in, the same place as if have a house and Bank of America owns the mortgage of the house. If your toilet breaks, you don't call Bank of America no matter what. They don't own the property. Therefore, they're not managing those day-to-day type of managements. We wanted to be in that position. So that's kind of how we positioned ourselves. And then I kind of, from that, worked out into different asset classes and was very drawn to commercial real estate very quickly for a lot of reasons. Most importantly, that it's traded on a multiple of income. So the value is understandable. I can understand and predict the value of the property based on cash flow and rental income. And then, I've invested in virtually every type of real estate transaction that exists because my goal, one of my virtues is just being able to sleep at night. And so the way that I've achieved that is through diversification in multiple different asset classes, multiple different geographic locations and sponsors. And self-storage quickly became a prominent role in my portfolio, as did mobile home parks for a similar reason. I'm extremely recession cautious and very, risk averse when it comes to cyclical investments. And both of those asset classes have tremendous value during economic corrections, which is something we can get into later. But, from a big picture perspective, the fact that demand for the product doesn't decrease when the economy is sluggish was a very good sign. And I identified that early on. And then the more I learned, the more I realized that it was just an incredible opportunity overall.
Yeah, let's stay on that. So from a big picture, looking at it macroly, what is the investment thesis of self-storage? And can you give my listeners a little bit of an overview of the industry and the desirability of this asset class?
Yeah, so a couple things that are pretty key is that the asset class is relatively new. And, in the mid to late 90s, this really became an unpopular investment vehicle for a lot of reasons. Number one, you're not providing that much. You're providing a very small service. And because of that, the expense ratio is very favorable for investors. Something else to take note of is the tenants are very sticky. What I mean by that is that the gross dollars amount is basically insignificant for them, even if you're very aggressive with your rental increases. So compare it to multifamily, for example. Let's say a 6% rental increase may be $50 or $100 a month. And that's enough for someone to consider moving. But when you look at self-storage, if you have an average place renting for $100 a month or so, if you increase the rents by 6%, you're talking about $6. So then the question becomes, who is going to take the time to take the day off work, hire movers, get a rental truck, and drive down the street to another self-storage facility where they're probably doing the same thing anyway? And it becomes clear that very, very few, and the math and the data has lined up very correctly with that thesis. So since the asset class is relatively new, though, it has been growing substantially. So in the 90s, it basically doubled from about 20,000 facilities nationwide to now there's about 53,000, which is massive. I mean, that's more than all the Subways, McDonald's, and Starbucks combined. And since that explosion took place in the asset class, the occupancy levels have remained high and the net operating income have remained high. So you just have this really interesting economic situation, a combination of the desirability from an investment perspective and the sticky tenant base, which results in, a really interesting asset class. And then to add to that, the recession resistant component is also quite strong. So I've always looked for investments that are stable in the sense of cash flow. Well, one of the ways to do this is to find asset classes where the demand for the product increases during recessions. So you think about why people use this product. You're usually going through some kind of life change, and a lot of those changes can be brought on by recessions. So when you think about kids moving home from college unexpectedly, foreclosures, layoffs, job changes, all of these are more common during recessions, and all of them make people more likely to be self-storage tenants. So the combination of all those things, it's got a lot of good things going for it. And there's some complexities in there as well, which could be a turnoff to some people, but I think it's a positive for me. But, that's pretty much the investment thesis and why I started jumping in, with 2 feet basically in 2013 or so.
Now, where does the opportunity lie in this niche? Because it sounds to me that there's a vehicle which, is recession resistant. It's very, very profitable. As you mentioned, the slight little increases that you can raise the value of the asset class without a lot of resistance. Are they easily, can you just go and purchase it? Do people build these facilities? And then how do investors create opportunity for themselves in this niche?
Yeah, those really important questions. And again, I'll just let you know, this is just my opinion. My opinion as an investor, I have a very niche type of strategy when it comes to investing overall. But generally speaking, I'd say that the real value has a lot to do with the fact that there's tremendous amount of mismanagement. And you compound the tremendous amount of mismanagement with the sticky tenant base, you have a really good starting thesis. So 77% of all the self-storage facilities in the U.S. are owned by independent owners. That means non-REITs. Many of these independent owners are mom and pop operators that have one property. So when you have one property, you simply don't have the systems in place that is required to run an effective self-storage facility. It's just very, very unlikely that you'd be able to know all the protocols to do this effectively. So my personal strategy is to find best-in-class operators in the self-storage asset class and invest with them while deferring to their expertise. Now, within that paradigm, I'd say that value-add self-storage is probably my favorite on a risk-adjusted basis because of the fact that there's a sticky tenant base and because of the complexities of the asset class. It's very unlike residential, for example, where residential comes down to, is there someone renting the property? Are they paying rent that's market rate? And that's pretty much the extent of, what you can do to kind of add value. But with self-storage, it's extensive. There's so many little ancillary items that can really increase the NOI if you're buying a property that's mismanaged. So give you an example, U-Haul is a big component of this. So there are plenty of properties out there that are worth $5 or $10 million that don't have a U-Haul component. So we can purchase properties based on in-place income, leverage our contact at U-Haul, allow U-Haul to park their their trucks on our facility and then rent those trucks out to the tenants and take a commission from U-Haul for facilitating that transaction. So that may not sound like that big of a deal, but when you consider the fact that, number one, that doesn't require any capital whatsoever. That's just a matter of leveraging a relationship. Number two, I have personally invested in a property where this took place, where the previous owner had $0 a month coming in from this commission to $3,500 and then $3,800 a month directly to the bottom line. I mean, if you're looking at that on a valuation basis, you're talking about $500,000 of value, $600,000 of value just by simply implementing that strategy. So if anything else fails, you're adding value significantly within 3, 4, 6 months of implementing that strategy. And there's a litany of other strategies similar to that, which are very favorable on a risk-adjusted basis because it's just a matter of implementing those protocols.
When we're looking at the size of some of these properties, because I find like in niches like this and mobile home parks as well, there's kind of like a certain size where the REITs come in, where what makes it very, very hard for operators to compete with them. And is there like a unit size or a square footage size, or what type of size properties do those guys kind of tend to go after and up?
Yes, that's an important question. So we don't want to be competing with major players, not because our operating efficiencies can't compete with them, but just why would you make your life more difficult? Now, there's two ways to do this. Number one, typically speaking, self-storage isn't ideal for those type of players, REITs or private equity groups, because the asset prices don't typically get up into those tens of millions of dollars in range. So institutional players typically aren't looking at allocating capital to a $5 million self-storage facility, though it could be quite nice. Something else to consider is the markets. I have found, that the name of my company is Cashflow Connections, and the reason for that is that I want to connect investors with cash flow. So it's challenging to get the type of cash flow that I'm looking for in primary markets. And that's fine because that's where some of the more competitive markets are. So if you're looking in that $5 to $15 million purchase price range and you're looking at secondary or tertiary markets, you're going to be able to kind of stay away from that. Now, on the other side of things, we want to make sure the facilities have enough diversification. I mentioned earlier, sleeping well at night is like my overall goal as a business owner and an investor. And so tenant diversification is important here. So if you have a property that only has 20 tenants and 10 leave, you're going to have a problem. But if you have 100 tenants, it's not going to be significant. So we look for properties with 50,000 square feet, usually somewhere in the range of 50,000 to 100,000 square feet is typically where they end up. And this will give you close to 400 units as a minimum. And I think that, barring any really serious seasonality issues, which are definitely something to keep in mind, I think that you can sleep at night knowing that if 10 tenants move out, you're not going to have a huge deal to your cash flow.
What checklist do you use when you evaluate and underwrite an opportunity in a property?
Yeah. So I would say that for me, the first and most important thing is the property management group and the sponsor. So the implementation of these strategies that I'm outlining right now, this is something that any normal person can understand, but the execution of these strategies is critical. So the first thing I want to look at is the sponsor. Who are they? What's their track record? What gut vibe do I get from them? I mean, it sounds silly. It's difficult to write that in, some document that'll make it valid. But at the end of the day, the question is, are the sponsors and the property management group putting themselves in a position to deliver, or are they putting themselves in a position to overpromise and underdeliver? Because the former is totally great, and the latter is just completely unacceptable. So are they setting themselves up to build a long-term relationship with you, or are they just trying to get your little capital amount in for this one particular deal so they can get an acquisition fee and move on? So building those relationships is the first part of the underwriting process and the checklist. I'd say that looking at the loan terms is also really important. I'd say that 99% of all real horror stories that come in real estate have something to do with the financing. And if you can avoid that problem, you can avoid most of the principal loss situations you deal with in commercial real estate. So the loan also paints the picture of who the sponsor is. So I'll give you an example. In my opinion, the loan term is probably the single most important. That even includes loan to value. And the reason for this is that most banks aren't going to loan some insane loan to value, but banks will loan short loan terms. So if you're able to purchase a property and implement these value add strategies quickly, that's fine. But what happens if something takes place, something unexpected, those 1 in 100 type of things where their demand for the product slowly stagnates or decreases while you're trying to refinance? It can be very challenging. And there's a lot of real estate investors I have a lot of respect for that struggled during 2008 because of that very thing. The loan term was coming due at an inopportune time, and they were unable to attain financing going forward. So those are two. I would say that, without getting too detailed into some of the underwriting that I look for, I'd say that you want to be careful of a discrepancy between expense and income. So, for example, if rental increases are assumed to be 6% and expense increases are assumed to be 2%, that discrepancy is going to become very significant in the expense ratio later down the road in later years, especially if you're holding for 7, 8, 9, 10 years, which we sometimes anticipate doing so. So, I can go into a series of other things, but, those two are a really good start. The operator is going to be the most important. The loan is going to be very, very important. And then looking for small things in the underwriting model to kind of get a better picture of who the sponsor is, because I think when you're investing passively, it's really who it all comes down to.
And the plan that they have in place too, right? And the way that they present it, because as you mentioned, you'd rather have someone that under promises and over delivers. And usually when you look at pro formas, you should probably put the line in front of that once upon a time.
Yeah, 100%. Absolutely. Is the plan something that makes sense? Is it viable real estate? That's a term that a guest on my podcast recently used, Ethan Penner, who's an absolute genius. Is this viable real estate? Are you trying to build the first self-storage facility ever built in this market? And does this market have a demand for the product? Is this a speculative investment in that sense? Or are you buying a property that's 60% occupied in a market that's 90% occupied that doesn't have any ancillary income? So for me, I'm in much more favor of those value add strategies because the demand for the product is proven, and it's just a matter of making the property perform to market levels.
You're listening to Hunter Thompson on the Cashflow Ninja podcast. We will be right back after a word from our sponsor.
Are you having a hard time finding great investment properties? Unfortunately, the best deals are rarely found locally. Successful investing begins with the right properties in the right markets. Norada Real Estate provides everything you need to invest in the best deals across the United States. Our simple, proven system will help you create real wealth and passive monthly cash flow. Learn how to find the best deals by downloading your free copy of The Ultimate Guide to Passive Real Estate Investing at noradarealestate.com. That's NORADA realestate.com.
You're listening to Hunter Thompson on the Cashflow Ninja podcast, and now back to our interview. You've mentioned the secondary markets. Now, across what markets do you guys invest in as far as statewide? Is it all across the United States? And then what are some of your favorite markets to invest in, and why?
Yeah. So, again, with the focus being on cash flow, I'd be happy to invest in Los Angeles. The problem is because people anticipate appreciation, the prices are bid up so much so that the cash flow doesn't make sense. So there are certain markets, though, that have favorable economic indicators that you can still achieve cash flow in. So Florida is experiencing tremendous amount of demand for self-storage because they're experiencing a tremendous amount of growth in terms of jobs and population and demographics, the correct demographic. There's a lot of seniors moving there, and those individuals create an interesting demographic. Charlotte, North Carolina is great. Charleston, South Carolina is great. These are markets that, if you're in this MSA, likely that you're going to be in a really favorable position in the next 5 to 10 years. So those will give you some ideas. Typically the middle of America, the Midwest and the Southeast make for good self-storage markets.
And then there a specific also kind of like consumer behaviors and certain trends in those markets that are attractive, along with, because there's a website that I follow too that's pretty interesting, how money walks, and it just follows all of the trends. You mentioned the demographical trend, but there's also consumer behavior in there. So how do those trends play in decision making about picking markets?
Definitely. So I'd say that there's two things you need to have a good self-storage market. You have to have people, they have to have stuff, and they have to have money to pay for it, right? So I guess that's three. If you don't have those, you're not going to have a good time, as they say. So more than that, though, I think that the median household income is important. I think that $50,000 is typically not a floor, but that's what you're trying to look for. Further than that, I'd say that 50,000 residents within a 5-mile radius, 20 to 25,000 daily traffic, I think would be probably reasonable. But keep in mind, those vehicles, they need to be able to see the property. So it can't just be that there's 25,000 vehicles driving by within 3 miles. It has to be that they can actually have access visually to the property, because a lot of people make that choice to leave their stuff at a self-storage place or to store their stuff based on drive-bys. So that's key. In terms of other behaviors, you can have a lot of success in self-storage looking at markets where they're in affluent areas specifically, sometimes vacation areas, lakes in particular, lakes, rivers, etc. People use water vehicles and therefore need self-storage. But something to keep cautious of is if you're using that and you're using a lot of RV parking, your income will be cyclical because of the fact that the boats will be on the water during the summer, etc. So it's something to keep in mind. But other than that, affluent markets that are, in my opinion, tertiary markets or secondary markets, so that you can get the cash flow but still get the foundation of both population and income.
Now, we've touched on the project and kind of this niche and why it's desirable and some of the qualities of it. We've spoken about the importance of connections, which I love about your company's name, Cashflow Connections, and the importance of partners and vetting and doing your due diligence on the sponsors and operators, the financing, which is a very important part. And then usually following those three key points, the management comes in. Who is going to manage this? A huge part of the secret sauce in real estate. What is your philosophy on management? Do you use a management company? Is it usually done management in-house through some of the sponsors that you do business with? Share a little bit more information about that.
Yeah, absolutely. So up until this point, we have only invested in opportunities that are sponsor managed. So the sponsor and the management company is vertically integrated so that we have kind of a flow through there that I think is really best for incentive alignment. And there's different strategies in terms of self-storage, in terms of who makes the best on-site property management company or on-site property manager. So one kind of school of thought is that you want to hire a young entrepreneur who's interested in moving up in the company, that has the ability to go out, do marketing, conduct this and conduct that, do a lot of upsells, etc. And then kind of the other school of thought is looking for a retired couple that is trying to live on the property and create a really homey type of environment, that wants to really create a mom and pop environment, but have the bottom line of a sophisticated operator. So those are the two things. And then I would say that I really like investing in A-class properties. And the difference between A-class, B-class, and C-class comes down to the amenities. So is there an on-site property manager there 24 hours a day? Is there 24-hour entrance? Is there climate-controlled units, which also can be a tremendous value-add opportunity. If you're buying properties that don't have any climate-controlled units, you can purchase exclusively climate-controlled units or extend exclusively climate-controlled units, add further value to the property, and also increases it in terms of the A-class and the B-class. What are they offering? Do they have an office? How safe is the facility? What's the visibility look like in terms of, is it lit at night and stuff like that? So management is key. And to answer your question directly, yeah, on-site property manager 100% of the time, and usually there's an office and an apartment above the office is typically what we've utilized.
Automation is a huge trend. And I mean, we talk about, especially now, the national conversation is looking at fast food restaurants and so forth. That, how big of a role does that play? Is the industry in this niche moving in that direction, especially with the A-class properties?
Yeah, that's important definitely to pay attention to. I would say that this is the second time actually someone's brought this up in an interview where people are pursuing the business plan. I have seen operating agreements and executive summaries where the entire plan is to have a fully automated self-storage facility. Now, I haven't really done too much due diligence on that process, so I'm not the expert in that industry, in that specific piece of the industry, but I would say that from my opinion, basically what I just laid out for you in terms of the A class versus the B class, it provides such a value add component having someone on site for a lot of reasons, almost all of which have something to do with ancillary income. There's so many items you can sell to these tenants while they're there. Boxes, scissors, upsells on climate control. You don't want to get your art ruined, do you? Well, we have this for an extra $30 a month. There is a unit that's going to be perfectly climate controlled so that your heirlooms can be protected, so your art can be protected. And that's tens of dollars that can potentially be brought directly to the bottom line, multiplied by how many tenants there are, thousands of dollars a month. And to me, that kind of it's not worth it. It doesn't make sense. I think that someone will eventually handle it. And of course, I think a lot of things will be automated. But as of right now, especially in the markets we're in, I think that having someone on site is key for a litany of reasons.
Now, how are you finding a lot of these deals and these opportunities, and who are bringing these opportunities to you?
Yeah, so in conjunction with the sponsors we work with, we have access to a tremendous amount of both on-market and off-market transactions. So when you're working with someone who has done hundreds of millions of dollars of deals, specifically if they're focused in a certain geographic location, they're going to have access to every single on-market transaction. And because of the name, they're going to be approached by people that have off-market transactions, if not a litany of other reasons. So, we have been lucky enough to leverage our relationship with these individuals so that we can have access to some of the best deals in the country, both on-market and off-market. And the reason I say on-market in particular is that this asset class can be a little bit interesting in the way that the discrepancy between the physical occupancy and the economic occupancy, which is how efficiently the property is running, can be a little bit misleading. So you could look at a property that's 92% occupied in a market that's 90% occupied, and most investors will just pass on that because they don't see the value add. But a sophisticated operator may find out that they're not offering any of these ancillary income items. They're completely under market rent, and the property manager is getting paid way too much. You can cut that and turn that around, and eventually, you can see the underwriting. You can find that the property may be 92% occupied, but it's 67% economically occupied. And because of the fact that the tenant base is incredibly sticky, you can raise rents aggressively. You can push that ancillary income very aggressively and get that up to that economic occupancy into the 80s very, very quickly.
Very, very interesting. Now, Hunter, can you talk a little bit about a deal flow and give us an example just of a case study of finding a property from basically discovery and an opportunity coming to you to eventually your exit strategy?
Yes, yeah, sure, absolutely. So, the first self-storage property I ever invested in was in Fayetteville, North Carolina, which will kind of give you an idea of the markets that I think are prime for this type of investment. And Fayetteville, North Carolina is a military market, so there's a military base there, meaning that these individuals make for good tenants because their deployments typically are longer than the average self-storage tenant stays. So that's a good start. We got a screaming deal on this property for about $6.75 million, about 1,000 units. And that's significantly not only under market, but that's also it's very, very low in terms of cost per unit. It was 76% occupied at the time of purchase, and the market was 85% occupied. So right there's definitely some value add. And I just remember there's actually the lack of RV parking, which can be very easily implemented by simply painting the parking into the ground. So the property is really mismanaged in the sense that there was plenty of spaces for things to be added. And once you started digging, you'd find things like the previous owner had not been selling merchandise. And we come in to see what's going on. He's renting out his scissors to people that need them when they're moving in. Literally renting out the scissors rather than selling them. So that may sound like inconsequential, right? You're thinking $7, what's it really matter with the profit margin, et cetera. But that is very telling in terms of the way in which the business was being conducted. So, add a couple of dollars here and there for merchandise sales, let's say $200, $400 in merchandise sales directly to the bottom line. And that's going to add really a lot of value to the property and by increasing your income. That property was one I mentioned earlier where there was zero U-Haul component, and now it's bouncing around between $3,000 and $4,000 a month directly to the bottom line. Something else that I haven't talked about yet, which also was included in this property, is mandatory tenant insurance. So most operators that are experienced will require that all of their tenants carry tenant insurance, similar to renter's insurance for when they're renting as tenants. And this alone can add $1,500 a month to a normally sized property, to a reasonably sized average property. And we now have this one turning out at close to $2,700 a month. So, we've added about $1 million of value just based on income, not even including any market corrections or anything like that. So we are looking forward to exiting this, though it hasn't finalized yet. But I mean, that's going to be very lucrative for us and our investors.
What time frame do you guys think that you're going to hold on to this? And is there a specific time frame in other investments too that you're looking to be in the vehicle before you're exiting?
Yeah, so, we want to be conservative on our numbers. And I think that's one of the mistakes a lot of investor groups do is they forget that time can be potentially the most important one of those numbers to be conservative in. And the reason for this is not only because of the loan, which I talked about earlier, but because of the fact that you want to set up your investors, in that sense, because they want to prepare for the future as well. So we typically look at a 7 to 10 year time horizon. And I think that's enough time to buy a property, implement these value add strategies that I was talking about, and sell during favorable market conditions. And that last part's the key. So you can buy a property and implement these strategies quickly, but the market and the capital markets and the economy may not put you in a position where you want to exit at that time. I think 7 to 10 years is a combination of all of those things. So for example, we bought that property in Fayetteville in 2013 and, it should be getting close to being exited here. We purchased it with a 7 to 10 year time horizon. So that'll kind of give you an idea of what we're trying to accomplish.
Now, one habit I've observed from wealthy and successful people is that they're always studying new subjects and learning new skill sets. What are you currently studying and what new skill sets are you currently learning?
Yeah, I've got to say that my brain is definitely influenced by Austrian economics. And I have found that people that are proponents of Austrian economics, sometimes there's just a rare type of person that is both interested in Austrian economics and also is interested in taking action on the implications. So, I myself consider myself a philosophical libertarian, but not a political libertarian. I identify with the libertarian creeds, but I also identify with the libertarian proponent of economics, which is the Austrian school. The problem is that I know so many people out there that are constantly fearing for recessions. They fear that the next recession is going to come. They're worried about, typical type of Peter Schiff type of stuff, which of course I have a lot of respect for Peter Schiff. And I saw he was on your show, which is just incredible. But the thing is, if you think that the recession is coming, you can build your portfolio around that. You don't have to sit and wait. You don't have to sit and wait for the rocket ship to explode. You can take advantage of that in a very positive way by catering to investments where the demand for those products increase during that time. So if you're interested in learning more about that topic, I'd say Tom Woods' podcast is probably one of my most influential podcasts that I listen to, as well as a bunch of other guys in similar camps.
Yeah, no, they're great. And we've discussed Austrian economics on the show. I had Carlos Lara actually on as well. And
oh, wow.
Soon to have Robert Murphy. So yeah, no,
that's very cool.
We talk about it quite a bit. So no, definitely couldn't agree with you more. Now, a core message in our show is to leave our families, communities, and the world better than we found it by passing down a mindset, values, and principles to future generations, not just money. So if you cannot pass on any money to future generations and we're only allowed to pass on 3 principles to them to build wealth and achieve happiness and success, what would they be?
I'd say that the first one is probably to take action. So when I say that, it doesn't mean that if you're thinking about investing in something that you don't understand, to just do it. That's not at all what I mean. What I mean by that is to pursue that in the event that you want to. So if you're interested in doing something and you are struggling to get over the hump of just beginning, I mean, that's most of the people out there struggle to do that. Now, beyond that, I would say that being yourself and tripling down on your strengths is just as important. So the combination, I really think that that's one. Identify what your strengths are and take action. And if you can do that, you'll be able to succeed. And, previously I have spoken about, I wouldn't call them failures, but lessons learned as an investor and an entrepreneur. And it really came down to the fact that I wasn't being myself. I was trying to be someone else. I was trying to mimic other people. And as soon as I started realizing what my strengths were and pursuing them exclusively, things started to change significantly for me. I'd also say that focusing on cash flow is key. You're never going to regret the time you focused on cash flow. It's the kind of thing that just is the gift that keeps on giving. And to me, it's the most direct way to achieve my financial goals, though everyone's financial goals are different. But for me, all of this is about being able to sleep at night, knowing you're well protected. And what I mean by that is paying off all of your expenses by cash flow. So those are the two. And the third would be diversification. If you pursue the first two that I just said and the third, then it should be good. But if you just pursue the first two, things can get really dangerous very quickly. So if you're taking action very quickly, and if you're only focusing on cash flow, but you only do it in one asset class, or you only do it with one sponsor, if you only focus all of your energy on your own business, which is what a lot of people do, if you're not focusing on a bigger picture, things can still go wrong. So diversification is one of those things that it handles all the other mistakes you may make because you're diversified. So those are the 3.
No, awesome. And thank you for sharing them. Hunter, how can my listeners learn more about you, your company, your podcast, and stay informed of all the projects that you're involved in?
Yeah, sure. So I'm the founder of a company called Cashflow Connections, and we help accredited investors invest in commercial real estate, particularly recession-resistant commercial real estate. We have a podcast called the Cashflow Connections Real Estate Podcast, and I've listened to several of your episodes. There's going to be a lot of overlap. So investors, especially those that are interested in real estate, will definitely get something out of it. And we also have an ebook just out recently called Passive Investor's Guide to Self-Storage, which I think will be linked in the show notes page.
Yeah, I'll put that in the show notes page. Thank you for sharing that with my listeners. And thank you for coming on the show and sharing your journey and your knowledge around this niche and providing so much value for my listeners.
MC, I can't thank you enough. It's absolutely an honor to be on here. I listened to several of your episodes in the past, and the guests you guys have are just unbelievable. So to be included amongst that mix is just incredible. So I can't thank you enough.
This is MC Laubscher, the host of the Cashflow Ninja podcast. As you may know, I'm also the president and chief wealth strategist of Valhalla Wealth Financial. We help individuals, families, small businesses, entrepreneurs, and professionals build their wealth outside of Wall Street and help investors maximize the use of every dollar in their personal economy and boost their investment gains. We do this by combining the capital and investments with the financial vehicle of the wealthy according to the infinite banking concept. If you're interested to learn more about privatized banking and the infinite banking concept, you can access an exclusive webinar at cashflowninja.com/be-the-bank. Thank you for joining my guest, Hunter Thompson, and myself on the Cashflow Ninja today. If you like what you hear and appreciate what we're trying to build here at the Cashflow Ninja, please subscribe, rate, and review our show on iTunes and share our show with family, friends, and your network. I'm always trying to learn and improve in every area of my life, so if there's any way that I can provide more value to you and serve you better, please reach out to me at info@cashflowninja.com. If you're not a subscriber to the Cashflow Ninja Gashku newsletter, you can sign up for our newsletter at cashflowninja.com or text Cashflow Ninja to 44222. You can support the show also by becoming a patron on Patreon for $10 a month. And when you do become a patron, you get access to our private Facebook page and a Cashflow Ninja t-shirt. You can become a patron at cashflowninja.com/support. Jimmy Freeland and Bob Scott have been in your shoes and have used real estate investing to become financially free. They've designed a system to take any beginner to an experienced deal-making investor in the least amount of time. They offer opportunities from basic education, coaching, bridge loan investing to turnkey investments in the cash-flowing market of St. Louis, Missouri. For more information, please visit joinupsproperties.com or call Jimmy and Bob at 314-799-2247. If you're not earning at least 8% on your cash or money in your self-directed IRAs, you do not want to miss the private lending presentation for non-accredited investors done by Jimmy Freeland and Bob Scott. Discover how to create an income stream from real estate without the management headaches. You can access the presentation at cashflowninja.com/private lending. Creating passive income for you and your family is easier than you think. All you need are three things: the right plan, the right product, and the right turnkey provider. As an investor, you want a safe, profitable, and convenient way to invest your capital without being at the mercy of stock market fluctuations. Investing in real estate in a turnkey way that provides monthly passive income with very low risk is exactly what Spartan Invest provides for their clients. Their mission is to make investing in real estate easy for the busy professional. Spartan Invest helps investors create passive income and wealth through turnkey ownership in Birmingham, Alabama. You can download your free report, 5 Big Reasons to Invest in the Magical City of Birmingham, Alabama, at cashflowninja.com/Spartan. The wealthiest families on the planet know how to capture their wealth and then leveraging their wealth through their own banking system. If you're interested in the infinite banking concept and learning the premier strategies of the wealthiest individuals and families on the planet, you can access a free webinar at cashflowninja.com/be-the-bank. That's our show for today, everyone. Until next time, live a life of passion and purpose on your terms.
You have been listening to the Cashflow Ninja with your host, MC Laubscher, the podcast empowering and inspiring people to discover how to generate their own income and manage, grow, and protect their own wealth in the new economy. Today's show notes and resources are available on our website, cashflowninja.com. This presentation is for educational and informational purposes only. The information being presented and considered does not consider your particular financial objectives or situation, and it does not make personalized recommendations. This material is not intended to replace the advice of a qualified tax and legal advisor or other qualified professionals, and you should not use the information in place of a customized consultation with a licensed professional regarding your specific personal financial objective, situation, and needs. We believe the information provided is reliable, but we do not guarantee its accuracy, timeliness, or completeness.